What is up, y'all? I wanted to add this on. I just finished the series. I actually got a lot better at making the videos as this went on. It's my first time really making videos. But bro, you will be profitable in 1 week, 2 weeks max if you actually take heed to what I am saying. I just wanted to add that because I guess I didn't say it, but you're gonna see some proof of concept here. So stay tuned. Christ is king. And let's get into it. I got guys who have done 4x their portfolio, and I started the group in April. I've been trading longer than that, but I started the group in April. I wanted to build some concrete evidence, and we're doing it. I gave this ebook out. I kind of made this ebook as a script because I started doing these videos, and then I was like, all right, I'm kind of bouncing all over the place. Pause. I need to walk them down linearly. So as you can see, how I make 400+% returns in the stock market using only my cell phone. You could be in Ibiza. Don't go to Ibiza because that's degenerate. The goal of trading, in my opinion, is freedom. I'm totally opposed to staring at the fucking chart and being a divination loser. You can front run retail by just having an accurate worldview. And we're gonna get into that probably episode 3 or 4 because these first episodes are just gonna be the logic of trading. I'm gonna make this as easy as possible, bro. At the end of the day, it's really buy low and sell high. And so I'm gonna show you how to do that. Most people are familiar with trading common shares because it's very straightforward. You buy at $10, goes to 100, you got a 10x, right? We all get psyoped by institutions and just mainstream Zog botness into thinking like 10% on the year is tremendous. Bro, 10% on the year fucking sucks, bro. I don't even think 10% on the year would have broke you even with inflation in 2024. What is the point of putting your life savings up to break even with inflation, bro? We gotta take risks. Warren Buffett yeeted $36 billion into Apple in 2017. He got $281 billion off of that. That's 681% return. That's the shit we need. I got a nice inspirational quote. In any walk of life, the system wants you in their box, the kosher box. All it takes to break out of that box is to realize there's a fucking box. Right? And then blow that shit up. Ask me any questions, but also talk to ChatGPT. Not like it's your homie, but if you don't understand a little sentence I said, go into ChatGPT, copy what I said, and go, what does this mean? And if you don't get it after it says a response, just keep walking through it. Walk with it. Walk with it. So chapter 1, we got options 101. Options were created as a tool or a method to manage common share entries and exits, and to also hedge against things. Options only give you 2 options. It's a call and a put. A call is a bet that the stock is going up before a certain time, and a put is a bet that the stock is going down before a certain time. Both of these options, call and put, give you the right to 100 shares per each contract. Option is just an umbrella term for either a call or a put, and contract is the amount of each put or call you are purchasing. If Nvidia is at $180 and you want to buy 100 shares of Nvidia at $150 share price, you go buy $150 strike price call, you would exercise the call, and then you would get 100 shares for $150 per share. Now, same scenario, if you say, I want 200 shares of Nvidia, you'd buy 2 contracts of the same $150 call. Hopefully that makes sense. Now let's say Nvidia goes to 100 and you don't want to sell at 100. You do some math and you can take more profit if you sell at 150. You got those 200 shares, right? You're gonna go buy 2 puts for a $150 strike price, and that gives you the right to sell those shares at $150 per share. You could choose any fucking strike price you want. Now, you don't want to choose some of the strike prices because it's just a terrible idea. If Nvidia is at $180, why the fuck would you buy a $400 call if you're planning on exercising the call? There's also something called in the money or out of the money. That's something we're gonna get into here in a second. For calls, as the stock goes up, a lower entry price is more valuable. If a stock's at 200, you get better returns if your entry's at $100 than if it's at $170. This should be straightforward. Because a lower entry price is more valuable, a lower strike price is going to be more expensive. If Nvidia goes from 100 to 200, a $10 call, the ability to buy a stock for $10 per share is much more valuable than the ability to buy the shares for $180. To kind of reinforce this, I'd rather have a 20x return than only be up like 4%. For puts, as the stock goes down, selling a stock high is how you make more money. So if the stock goes down, the option to be up at this strike price is so much more valuable. So for puts, a higher sale price is more valuable than a lower one. That means the higher strike price is going to be more expensive. An example is if Nvidia goes from 200 to 100, a $200 put is more valuable than a $10 put. To reinforce this, I'd rather be able to sell at the top than sell negative, because Nvidia's at 100, a $10 put's down here, bro. Why would you do that? Using options to manage entries and exits is called exercising options. These options are always repricing as the stock goes up or down, and there's some other factors into it like volatility and time decay, and we're gonna get into that. Those are really the two most important. The rest of them are for geeks, and I really don't believe anybody who's profitable uses things like Rho and Gamma, but I'm gonna show you all this, so stick with me. As the stock goes up, calls get more expensive. As the stock goes down, calls get less expensive. As the stock goes down, puts get more expensive. And as the stock goes up, puts get less expensive. Let's do a little quiz. If Nvidia is at $150, which call is more expensive? A $140 call or a $10 call? If you said $10 call, bing, 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 let's fucking go. The $10 call would be more expensive because it's more advantageous to have. It's more valuable. If Nvidia is at $150, which of these puts would be more expensive? A $200 put or a $1 put? The $200 put would cost a lot more because it is valuable. And buying a $1 put is crazy, bro. If you ever buy a $1 put, just quit. It's like scoring on the other side of the fucking basketball court, bro. So like I said, one call or one put is one contract. Two calls or two puts is two contracts. If you said, I want to buy 1,000 shares of Nvidia, how many calls do you need? 10, right. If you want to sell 500 shares of Nvidia, how many puts do you need? 5, correct. All right, good. You're catching on. Like I said, exercising options is a big money tactic. 99% of options traders are flipping the contract for profit before expiration because, like I said, these contracts revalue as the stock goes up and down. So this cost that we've been paying for the option, this cost that we've been paying for the contract/option, right? That is called a premium. That is what we're paying. That's the cash amount that is going up or down, and it's what we are trading. Pretend this is a legal notice that says I am allowed to buy a BMW, whatever the fuck, for $4. This shit is worth a lot of money when BMW is worth a lot of money. If BMW goes out of business and they start blowing up, dude, who cares about some legal right to buy a car that sucks? We're flipping the premium. And that premium is essentially a rental fee to the market to own the shares until a date that you specify in each option. There's two main parts to when you're choosing the option, and that is the strike price and the time to expire. That's why options are leveraged, is because we're putting a time limit on our bet of where the stock is going. Now, if you go, Nvidia's at $50 for all of these reasons, and I know it's going to 100 before the end of the year, you can go buy a call with 6 months to expire or 3 months to expire if you feel like 3 months is adequate. The premium of one contract is always going to be cheaper than buying 100 shares outright. That is why people do it. It's a cheaper way to get in on something going up, or it's a cheaper way to bet on something going down. And that's why it's leveraged. Your money moves more rapidly, but you pay way less money in order to get in on these trades. So it's double XP. To reinforce that, when a stock goes up or down just 1%, an option contract can move anywhere from 4% to 100 and something percent. An option is a bet on where a stock is going, and you get to configure that motherfucker. You got so many options, no pun intended. So like I was saying, date to expiration is a big factor in a contract's value. The further out the expiration date is, the more expensive it's gonna be because there's more time for what you want to occur. More time equals more opportunity. The shorter the date of expiration, the cheaper, because it's riskier. There's less time for this action to occur. Here's the written format of how you'll see these on exchanges. I'm gonna make a bonus video literally showing you how to trade options and navigate Robinhood so you know what to do when you show up to the pond. I'm not gonna leave you out to hang. So here's the breakdown. $100 is the strike price we chose. Nvidia is the company. A call is the option we chose. You only had two choices. And the date at the end is the expiration date. You get to choose all of these. Now we get into some fun stuff. And this is what I was talking about with finance kind of gatekeeping free bands, because they use esoteric language to talk about this shit. The Greeks. The Greeks are some statistics about an option. They can tell you a lot about how a contract or an option is going to revalue, because we got things like theta, which theta is time decay. And time decay is how much value is taken off of the option per day. It's basically kosher, take a fee off the top. It's not a big deal unless you're just buying options with crazy time decay. But it's worth looking at because you want to make sure it's a binary choice. Is this theta fucked or is it fine? Delta is the rate the option revalues at per the stock moving up or down $1. Delta and theta are the only ones worth worrying about. Some people use gamma to identify setups. A setup is basically just you identifying, hey, there's an opportunity here. I think that's divination. We like real facts. Vega and Rho are irrelevant, but you can read them right here. Vega is a play on implied volatility. Implied volatility is a big deal. What will happen is a stock is twerking up and down on the chart and you're like, bro, but it's up right now. Why is my option not like up super big? It's because implied volatility is really high. So implied volatility is basically like a risk management statistic. It's not that big of a deal. Just sometimes your options don't revalue the way you want them to. And sometimes if you get a little bit of a drawdown, your options don't go down as bad as they might otherwise would have, because implied volatility is high. If implied volatility is down, that's basically the market saying this price is more certain. High IV equals higher premiums, but options move less. Like I was saying, low IV equals cheaper premiums, but the option price revalues more on the moves. It's typically in a range from 50% to 130%. As far as I've seen, I've never really seen anything below or above that. Sometimes I'll see 40, but those are pretty small caps. Like I said, IV is mostly moot, but at times you'll notice some lackluster movement because of it. I know this has been a dump of info, but we need to understand this stuff so we can get to the entertaining part and do the moonwalk. Like I was saying earlier, when you're buying calls or puts, the strike price is going to either be out of the money or in the money. So imagine this is the line chart. A stock's just been going up, right? Boom. Out of the money is above the price action. In the money is in the price action. And on puts, it's the other way. Out of the money is down here. In the money is above here. Puts are a little bit more confusing because a put can be in the money and it never happened before, but it's basically just whatever's on the other side of the line as far as price action goes. If we got puts and we think a stock is going from $10 to $1, anything above $10 is in the money. Anything below $10 is out of the money. Think of this in terms of the north and south side of the price action. In the money calls are always worth more than out of the money calls because in the money calls are lower entry. In the money puts are always worth more than out of the money puts because higher sell point is more advantageous than a lower one. Everything I've explained so far is all you need to know in terms of options revaluing. If you're really curious, you can look up Black-Scholes model because this is the formula. This is the actual math equation, but I just showed you how to intuitively follow price without doing Black-Scholes model on your options. Nobody does that, bro. Don't overthink this shit. I'm just trying to explain the physics of it. Just a little disclaimer, because I'm a truthful guy. You can technically lose 100% of your money trading options, but if you do, you're a retard. I'm sorry, it's true. First of all, you should have some form of a stop loss, bro. If you're down 86% somehow, just sell that shit, dude. Unless you're just chatted up and you know something. Buy at good times, and that's what we're gonna get into. That is the meat of this stuff. I'm giving y'all the milk right now. I think that's a good first episode, to be honest. I'm gonna have to chop this up because I've just been screaming, and hopefully I'm not too loud. Second episode, we're gonna get into some theory. Once you're done with this video series, you will at least know what you're doing in terms of research, in terms of pattern recognition, in terms of how to capitalize and strategize on the things you're seeing, then also how to hedge against things. So yeah, I will catch y'all in the next one. These videos are about to get way more fun. Please stick around, drop a like, drop a follow. My Discord is completely free. It will always be free. Every time I take a trade, I put it in there. The second I do the trade, I'm on my phone doing this, so I just swipe into Discord and say what it is. So I will catch y'all in the next one.